Monaco got rich by doing two things that sound like the last acts of a country going under. First, it sold 95% of its own territory. Then, 8 years later, it announced that nobody living on what was left would ever pay income tax again. Same prince, both decisions inside a single decade. And the second one is not a historical curiosity. It is still the business today, 157 years later. And every line of Monaco's national accounts is a toll collected on people who accepted that offer. What it does not run on is the casino. The casino is the first thing anybody thinks of. And last year, the entire budget line that contains it came to 2.5% of what the state took in. Not a quarter, not a tenth, 2.5%. And even that is shared with the phone company, the electricity company, and the ports. So the country that gambling built stopped being funded by gambling roughly a century ago and never corrected anybody. There is one decision underneath all of it, taken in 1869 by a man who had just sold most of his kingdom to pay for it. Once you see what that decision actually was, the modern budget stops looking strange, including the 8 billion euros this 2 square kilometer principality has sitting in a savings account, and the 676 million euros of gold inside it. Like this video, subscribe, and then go and do something for the comments. Find out what rate of income tax you actually pay where you live. Not the number you assume it is, the real one. After everything comes off, post it with your country next to it. And if you have been to Monaco, put what you paid for a coffee there underneath too. Monaco's rate is 0, which is what the rest of this is about. So between those figures, the comment section should end up a reasonable map of everywhere that is not here. In 1861, Monaco was finished. It had spent the previous 13 years losing an argument with 2 of its own towns. Menton and Roquebrune had declared themselves free cities in 1848 and refused to come back. Between them, they were about 95% of Monaco's land and roughly 3/4 of its population. Take them away, and what remained was a headland, a harbour, and a palace. So, on the 2nd of February, 1861, Charles III signed a treaty with France. He formally gave up both towns. In return, France recognized Monaco's sovereignty, paid him 4 million francs, and agreed to connect what was left by road and rail. Read that deal again, because it is the founding transaction of the modern country. Monaco gave up territory and received recognition. It converted land, which it plainly could not defend, into legal status, which it could sell. Everything that follows is a variation on that one trade, and Monaco has never stopped making it. But recognition does not pay for anything on its own. A sovereign rock is still a rock. Charles had 4 million francs, a country the size of a large farm, and no economy. On the 2nd of April, 1863, a businessman named Francois Blanc paid 1.7 million gold francs for a 50-year monopoly on gambling in Monaco. The Société des Bains de Mer was born. 3 years later, the new district around the casino was named Monte Carlo, Mount Charles, after the prince who had just sold most of his kingdom to pay for it. Blanc was very good at this. The casino worked immediately, and it worked enormously. Now, here is the part that decides the next century and a half, and it happened in 1869, 6 years after the doors opened. Charles III abolished direct taxation on his subjects entirely. That is the turn, not the casino, the abolition. That is the turn, not the casino. The casino is the machine that paid for it, and the machines get replaced. Monaco has swapped its machine out several times since, and the abolition has never moved an inch. And there is one rule attached to it that tells you exactly what the design was, because it survives to this day. Monegasque citizens are not allowed to gamble in the casino. They cannot walk into the gaming rooms of the building that funded their own country. The ban came down from Princess Caroline, and the logic was blunt. The casino existed to take money from foreigners and spend it on locals, and letting locals feed it back in would defeat the entire point. State that plainly, and you have the business model of Monaco in 3 sentences. Build a machine that extracts money from people who do not live here, Spend the proceeds on the people who do. Make absolutely sure the two groups never blur is still there. And the government of Monaco owns 64.2% of it. In its most recent financial year, it turned over 861.6 million euros, up 12%, a record. Gaming was 259.6 million of that. Hotels were 443.1 million. So the oldest gambling company in the world now makes about 30 cents in every euro from gambling, and more than 50 from hotels and restaurants. The rest is rent on property it owns. It is a hospitality and real estate business that happens to own some roulette wheels, which means when people say Monaco is funded by the casino, they are wrong twice over. The state's whole concession line is 2.5% of revenue, and the company sitting inside that line is itself only about a third gambling. One more figure for scale, from the same budget. The line covering the Prince's Palace and the sovereign household came to 56.9 million euros last year. The palace costs the state slightly less than the casino, the phone company, the power company, and the ports bring in. Combined, two numbers almost the same size, and both of them are rounding errors against the real business. So, what is the real business? Last year, the government of Monaco took in 2.46 billion euros across roughly 38,000 residents. That is 64,800 euros a year per person, collected from a population that pays no income tax, no wealth tax, and no capital gains tax. Half of it, 50.3%, 1.24 billion euros, comes from one source. That is about 32,600 euros a year for every resident from this single line. It is not gambling, it is not the Grand Prix, it is not the yachts, and it is not banking. It is a 20% sales tax that Monaco did not set, does not control, and does not collect on its own behalf. Monaco charges 20% VAT, with the same reduced rates of 10, 5.5 and 2.1% that France uses. It uses the French rates because it has to. Under the customs agreement signed with France in 1963, Monaco sits inside the French customs and VAT territory. It collects the tax, it hands it to the French state, and France pays a share back under what is called the shared account principle. So the most famous tax haven on earth does not set the rate on half of its own income. It is applying somebody else's tax inside somebody else's system and receiving a share back by agreement. And it works spectacularly, for a reason that goes straight back to 1869. VAT is not a tax on earning, it is a tax on spending, and Monaco has spent 150 years assembling the highest concentration of spending power that has ever existed inside one postcode. 38,000 people in 2.08 square kilometers. Depending on whose count you take, somewhere between a third and 4 in 10 of them are dollar millionaires. The densest concentration of wealth anywhere on earth. Over 140 nationalities. Only about a quarter hold Monegasque citizenship, so 3/4 of the people living there chose to be there. That is the whole trick. Monaco does not tax your income. It taxes what your income does next. You bring the money in, untaxed. Then you rent somewhere, and you eat somewhere, and you buy a watch, and you fill a boat with diesel, and you have the boat cleaned, and you pay somebody to manage the money you did not pay tax on. Every one of those carries 20%. Somebody paying zero income tax and then spending 400,000 euros a year in Monaco was handed the same state an enormous amount of money without ever filling in a form. The state does not need to know what you earn. It only needs you to be there, which is the 1869 rule, running on modern equipment. Take from the people who came. Spend it on the people who were already here. There is a version of this where Monaco is a clever little country that outmaneuvered everybody. That version is wrong. And the reason is one evening in October 1962. France had been watching French nationals become Monaco residents for years, a flow that accelerated sharply as people arrived from Algeria, and had concluded that a fair number of them were not meaningfully living there at all. They were living in France with a Monaco address. Talks were held. Prince Rainier III and his advisors walked out of them. So, on the evening of the 12th of October, 1962, French customs officers set up on the road into Monaco. The blockade itself was small, a handful of officers, and it lasted hours. As theater, it was perfect. It demonstrated in a single evening that Monaco's entire economy sits at the end of a French road, drinks French water, draws French power, and is surrounded on three sides by France. Negotiations resumed fairly quickly. The agreement signed on the 18th of May, 1963, is the real constitution of Monaco's economy, and two things came out of it. First, French citizens who moved to Monaco after 1957 would pay French income tax anyway. The exemption was closed to the one nationality most likely to use it. Second, any company doing more than 25% of its business outside Monaco would pay corporate tax. That rate is now 25%, and it is not a small line. Corporate income tax brought in 306.5 million euros last year, 12.4% of state revenue. So the tax-free country has taxes, a 20% sales tax funding half of it, a 25% corporate tax funding another 8%. What it does not have is a tax on personal income, and it does not have that because France has agreed it does not have to. Monaco's tax freedom is not sovereign. It is licensed, and the license was renegotiated once, at the side of a road, in an evening. If sales tax is half the budget, land is most of the rest. And this is where Monaco stops resembling a country and starts resembling a very well-run property fund with a flag. The average price of a square meter in Monaco last year was 57,569 euros. In Larvorto, the most expensive district, past 71,000. Even in the cheapest neighborhoods, you are above 43,000. That is the most expensive residential ground in the world by most measures. And it is not close. Every time any of it changes hands, the state takes a cut. Transfer duty is 4.5% for an individual buying in their own name, and 7.5% if the purchase runs through a structure that does not disclose who is behind it. That surcharge is not an accident. It is a price on anonymity, and plenty of buyers pay it. Those duties sit in a line called legal transactions, and last year it brought in 334 million euros. 13.6% of the budget. It grew 34% in a single year, the largest jump of any line in the accounts. Then there is a separate line again, real estate, 280.8 million euros, 11.4%. That is rent on property the state itself owns, plus the public car parks. The government of Monaco is not just the tax authority on this market, it is the landlord inside it, holding around 2.1 billion euros of property in Monaco and in the French communes next door. Add the two property lines together, and you get 25% of the national budget. A quarter of the state's income is in ground itself, taxed when it moves and rented out when it does not. And all of it rests on a number that cannot change. 2.08 square kilometers. Scarcity is the product. Every other government on earth treats a housing shortage as a problem to be solved. Monaco is the only one whose balance sheet improves the tighter it gets. Which brings us to the strangest line in the accounts. Last year, Monaco spent 960.7 million euros on capital and investment. 42% of everything the state spent went on building things. Not health, not welfare, not administration, construction. No normal country spends like that. Monaco does, because Monaco is the only country on earth that can manufacture more of its own scarce product. On the 4th of December 2024, it opened Mariterra, 6 hectares of new district built out into the Mediterranean, designed in part by Renzo Piano, 11 years in the making, 2 billion euros, 110 apartments, 10 villas, and 4 townhouses. It made the country 3% bigger. 2 billion euros, 124 homes. That is about 16 million euros of construction behind every front door, before anybody has bought anything. Strip the architecture away, and the transaction is this. Monaco worked out that the binding constraint on its economy was the number of square meters available, so it spent 2 billion euros making more square meters. in the most expensive property market on the planet. It is the only sovereign state that can answer demand by building more of it itself. And every one of those homes gets sold, taxed at 4.5 or 7.5% on the way in, then furnished and lived in and spent from at 20% for as long as somebody owns it. There is one more part of the arrangement, and it is the part that makes the rest of it affordable. Monaco has about 38,000 residents. It has 77,866 jobs. Around 56,000 people commute in every day, mostly from the French towns immediately around it, and from Ventimiglia over the Italian border. More than 6 in 10 employees are French. Fewer than 4 in 100 are Monegasque. So the workforce is twice the size of the population, and most of it sleeps in another country. That is not a quirk of geography. It is the most valuable arrangement Monaco has. It gets a full-service economy, waiters and nurses and builders and bank clerks and cleaners, without carrying the cost of housing them, schooling their children, or paying their pensions. Those costs land on France and on Italy. The productivity lands in Monaco and gets taxed at 20% on its way through the tills. 38,000 residents are running an economy that produced over 10 billion euros of output last year, spread across the people who actually do the work. That is around 132,000 euros per job from a workforce that goes home at night. The residency side runs the same way in reverse. To live there, you generally need around 500,000 euros deposited within a Monaco bank, somewhere to live, and a clean record. The deposit is not a fee, it stays your money. It just has to stay there as proof you can support yourself. So the price of admission is not a payment. It is an agreement to park capital inside the country's financial system. Multiply that across tens of thousands of residents, and you have built a banking sector out of entry requirements. Financial and insurance activity is now about 18% of Monaco's output. Nobody is charged for the privilege of living there. They are charged for everything they do once they have it, which is once again 1869. It would be dishonest to run through all of that and leave you thinking it comes free. In June 2024, Monaco was placed on the Financial Action Task Force grey list, the international register of countries under increased monitoring for money laundering and terrorist financing. The European Commission listed it as high risk at around the same time. Monaco has taken it seriously. It has rewritten large parts of its framework, and by the June 2026 plenary, the task force found it had substantially completed the action plan set 2 years earlier. It is still on the list. An on-site assessment has to happen before anything changes, and no date has been set. That is the predictable bill. A jurisdiction whose core offer is that you may keep your money and nobody will ask very much about where it came from, will sooner or later attract money that has reasons to prefer that arrangement. Monaco is now spending real institutional effort proving it can tell the two kinds of clients apart, having spent a century advertising that it would not. There is a fair argument on the other side, and it deserves stating. Monaco's residency rules are not a secret. Its corporate tax is real, its banks are supervised, and the grey list is a monitoring register rather than a finding of guilt. Plenty of countries with far larger financial systems have sat on it. Whether a place like this should exist at all is a political question, and people answer it differently depending on what they think tax is for. What is not in dispute is that the model works financially. Last year, the budget ran a surplus of 179.7 million euros, the second largest on record, after years of surpluses before it. Behind it sits the Constitutional Reserve Fund, the country's savings account, which passed 8 billion euros, 2.7 billion invested, 4.6 billion in property and company shareholdings, and 676 million euros of it in gold, which gained 46% in value in a year. 8 billion euros across 38,000 residents is about 210,000 euros of national savings standing behind every person who lives there. Monaco's savings are more than 3 times its annual revenue. Very few governments anywhere can say that. Even the famous parts behave according to the same logic. The Grand Prix, the race everybody knows, has historically paid the lowest hosting fee on the Formula 1 calendar, somewhere around $20 million, while other circuits paid north of 50, because Monaco is a race the sport wants rather than the race that needs the sport. That has roughly doubled since under the latest deal, but for decades the most glamorous event in world motorsport was effectively subsidized, because Monaco understood the pictures were worth more than the fee. The pictures were always the product. The casino, the harbor, the race, the palace, none of them are the business. All of them are the advertisement. So, how did Monaco get rich? It got rich from what it did with the gambling money, once in 1869, and then never changed its mind. Charles III sold 95% of his country and used the proceeds to buy a casino. The casino paid for the abolition of income tax. The abolition attracted people with money. The people with money spend money, and the spending is taxed at 20%, and the land they compete for is taxed every time it moves. And the workers who serve them arrive in the morning from France and take their own costs home at night. Monaco does not sell gambling, and it does not sell glamour. It sells one thing, and it has sold the same thing for 157 years. It sells you permission to keep your own money in a place a great many other people badly want to be. There's a shelf of videos on this channel about businesses that charge you almost nothing for the thing you came in for, and everything for what happens once you're inside. Casinos, private members clubs, gas stations, movie theaters. Monaco is that same instrument at national scale, with a flag and a seat at the United Nations. And there are more countries coming after. The new playlist is below. Subscribe for those, and like this one if it earned it. The casino was never the business. The casino was the thing that paid for the decision once in 1869. The decision has been the business ever since, and it stopped needing a roulette wheel about a century ago. Hope you enjoyed this video. We'll see you in the next one. Bye bye.
I am